To Tom Murphy. He is a managing partner of the Family Office Research and Management, looking after investments for some of Australia's wealthiest people. Tom, thanks for joining us. Well, I'm going to ask you first of all about these wealthy people that are your clients. Tell me, what are they buying?
Rishaad, I don't think I've ever seen a time when so many of the most sophisticated investors in Australia are no longer following a traditional asset allocation model, but are instead looking at a very large cash hub from which they take risk positions and return to cash. It's a very different mindset, but it's almost like looking at all other alternative and traditional assets as satellites to cash. So the emphasis is very different. The emphasis is on income and preservation. But at the same time, we do get some questions from clients that are really, really interesting and a bit out there as far as what you'd expect to hear. And I'm reminded of the program you ran this morning with Bloomberg's Paul Gordon, when he was talking about natural gas, because that's a subject that hasn't been discussed enough. And our client base continuously asks us for exposure to the Gladstone region of Australia, where natural gas, coal seam gas, is being extracted or is going to be extracted. They're looking for these exposures because they're acutely aware of the massive capital inflow to Australia that is going to be coming from Japan, which was the subject of the Bloomberg story earlier today.
Yeah, we're aware of it. Yeah, Paul was, of course, all over that one. But, you know, you say some of these things are out there, okay, so let's get another one. So that's one which is out there. What about some of the other, let's say, non-traditional investments that people are seeking? And also the other thing is it only because Australia's got actually a reasonable interest rate which keeps people in cash?
I couldn't agree more, Rishaad. The interest rate of 4.25% on the cash side produces a real rate of return when you look at it at inflation in the mid-2s. We're probably the only major industrialized country in the world where the interest rate actually pays you to do nothing. So that is a luxury, and that does enable clients to use cash as the default position. In the UK and the US, that would be impossible. So people are not buying shares here because they need a yield. They can get the yield elsewhere. So they're looking at infrastructure, they're looking at private equity, but with private equity, they're looking at single managers, not fund of funds. They want to control more the exposure and the manager selection than they did 5 years ago. That's a critical change, and it's a little bit of an indication of a mistrust in the financial services sector to make allocations for them.
Okay, so, you know, tell me again what's more out there in terms of some of the more esoteric investments that you've actually had to deal with.
Well, I mentioned energy particularly because it isn't just the fears of Middle Eastern conflict that are prompting investors to seek energy investments. It's actually the demand for natural gas from Japan, and it's a turning off of the nuclear demand out of places like China, which are now going offline with all the power, or Japan, I mean, to go offline with all the power plants. We're aware of the increases in China there, but that is a fundamental change on the energy side. And on the private equity side, it's not large cap buyouts from Blackstone, Carlyle, and the leaders in New York. It's mid cap buyouts from Australia. The demand is for companies that the investors can touch and feel, they know, or brand names that they know, where buyout managers can actually do the work directly right here in Australia. We're seeing that demand. And when I talked to you at Christmas time, as I mentioned on the income front, there are many, many inquiries for off-the-run, more risky fixed interest and variable interest style assets. Not senior bonds, but 2 or 3 notches below senior. So they know which names they want to support on the credit side, and they're happy to take more risk and less liquidity on those names. So the conversation around income has become quite complex, and the conversation around alternative assets has gone right away from hedge funds, and it's moved toward infrastructure and private equity.
Tom, I want to also, find out what you make of what's going on as far as the global equity markets go. Great run up through the beginning part of this year, just seeing a bit of a gut check taking place. But it is an election year in the US, and that tends to be, well, pretty much supported when it comes to the American equity markets at least, and they tend to dictate where the rest of the world goes. But also on top of that, possibly getting a bit more flexibility, or should I say a bit more easing in China as well, and that could also be beneficial.
They're actually the two driving factors, in our opinion, that will drive equity markets this year, and they will drive them upward. The move in the United States, which was reinforced by Ben Bernanke's statement last week, is a move that is indicative of Fed support for accommodation. So the money supply issues are going to be dealt with beautifully for the rest of this year because we're in an election cycle, as you said. In China, it's really interesting because we had a reserve requirement cut by the Chinese in December and another one early this year, but still no cut in the business lending rate. And the business lending rate is about to move. And once it starts to move, and I admit it'll be in a staircase, slow fashion, but it will really surprise some investors because it will mean that that statement recently that China is going to grow at 7.5 was really a statement between the lines that China is a little bit uncomfortable with the slowdown, and the statement did not mention inflation. And a year and a half ago, that was the primary motivator of Chinese policy. So that's a big shift we're seeing. And once the Chinese cut rates, I would say that emerging market shares, especially in Asia, will lead the world. And I still think we have a double-digit return for the rest of this year, in addition to what we've seen in the first 3.5 months.
Tom, thank you very much indeed. Great to see you as ever, Tom.